What's up, Japan Market Samurai, broadcasting fresh updates straight from Japan. Let me ask you something. Are you seriously still thinking Japan's rally is just another short-term play on the weekend? Or worse, are you ignoring Japan altogether while global smart money is quietly rotating in? Because if you're still sidelined, thinking it's just AI hype, it'll fade, you might be missing the most under-the-radar mega cycle since Taiwan's semiconductor boom. Don't say I didn't warn you. Look, this isn't about intuition or being some macro wizard with a Bloomberg terminal in your brain. You don't need market genius to understand this. All you need is a framework, a new way of viewing Japan, not as yesterday's empire, but as today's AI infrastructure backbone. This is no longer a narrative reserved for insiders or native Japanese speakers. You can learn it, you can profit from it, you just need the right lens. Imagine this, you're holding a midterm portfolio, balanced across US software, Taiwan logic foundries, and Japanese inspection hardware. You're not riding hype, you're backing the very tools Nvidia and TSMC rely on. You're hedging geopolitical risk. You're front-running capital flows before Wall Street headlines even catch on. You're looking at Lasertec and thinking, this isn't a theme stock. This is the infrastructure of the next decade. That's the kind of clarity we're building here. I get it. Maybe you felt burned before. Maybe you bought the 2021 hype and saw it fade. Maybe you're thinking, Japan, isn't that the land of zombie companies in lost decades? I hear you. But what if I told you that entire view is now obsolete? What if I told you most investors are still blind to Japan's industrial chain dominance and you're about to leap ahead? This isn't for everyone. If you're happy chasing headlines and meme tickers, this isn't your place. But if you're ready to break free from surface-level narratives and see what elite global allocators are seeing, you're exactly where you need to be. But I don't speak Japanese. But I don't follow Japanese earnings. But the Nikkei is hard to analyze. Excuses. If you've made it this far into the video, you're already above average. Let me be blunt. Ignorance is expensive, and staying on the sidelines because it's too unfamiliar, that's the costliest position of all. You don't need fluency, you need frameworks, and that's what I'll break down for you. You know what's wild? The biggest foreign inflows into Japan today aren't from hedge funds. They're from disciplined individuals like you, people who opened their eyes early before the crowd, just like someone who bought TSMC in 2015, or someone who saw ASML's potential when it was just a supplier. You don't need to be first, you just need to be early. That's your edge right now. What I'm about to share isn't surface-level news. It's distilled from primary sources, direct statements, earnings calls, and Japan's own institutional behavior. And if you think this video is already valuable, just wait, because what comes next could reframe your entire approach to Asia exposure. So before we dive in, hit that subscribe button, smash that like if you're done with shallow takes, and get ready because Lasertec's limit up today is not a one-off. It's the first domino. Let's get started. Step 1. Don't trade the trend. Understand the structure. Conclusion. Japan's rally is structural, not speculative. Most global investors still see Japan's market rally as a short-term trade driven by currency moves or a temporary AI theme. But that's a dangerous misread. What we're witnessing is not a bubble. It's the result of deep structural shifts in corporate behavior, capital allocation, and market reform. The Nikkei breaking above 51,000 isn't just about sentiment, it's about earnings growth, operational efficiency, and institutional change. If you're still calling this just another 1989, you're playing the wrong playbook in 2025. Reason the rally is backed by fundamentals and reform. There are three main pillars behind Japan's structural momentum. 1. EPS growth. Japanese corporates are reporting real bottom-line growth, especially in tech and manufacturing. This isn't driven by multiple expansion or hope, but hard earnings. 2. ROE improvement. Return on equity has been a weak point for decades in Japan, but over the last 5 years, that's changed. Companies are streamlining, divesting non-core businesses, and reinvesting more efficiently. 3. Shareholder returns. Buybacks were almost non-existent in Japan 10 years ago. Today, they're surging, thanks to Tokyo Stock Exchange reforms, pushing companies with low PBR, price-to-book ratios. Firms are being forced to unlock value. Together, these shifts are reshaping Japanese equity culture, from passive conservatism to active shareholder value creation. This is not about market timing, it's about market transformation. Example, Lasertec and Vantage prove the shift is real. Let's look at Lasertec. This week, the stock hit its daily limit up, closing at 28,575 yen. The day before, Vantage surged after upgrading full-year guidance by plus 25% on stronger than expected AI-related demand. This is not random. These are real businesses with critical roles in the global semiconductor supply chain. Lasertec manufactures inspection systems for EUV photomasks. Without this layer, ASML's high-NA EUV rollout would stall. Advantest leads in chip testing, a necessary step before any AI processor hits production. More importantly, these are high-priced stocks in a price-weighted index. In the Nikkei, stock price, not market cap, drives index movement. So Lasertec and Vantage are literally powering the index rise. Not because of hype, but because of actual earning strength. And here's the kicker. This trend isn't one-off. It's been building for years, as Japan's tech ecosystem quietly rebuilt itself while the world wasn't watching. Summary, this is not 1989, it's a new Japan, backed by real numbers. Back in 1989, the Nikkei's rise was driven by fantasy valuations and land speculation. There were no earnings, no buybacks, no corporate governance. Today, we're looking at a Nikkei with a forward PE around 1620, PBR around 1.6, and robust earnings momentum in key sectors. This is what a healthy rally looks like. It's supported by policies, fueled by corporate shifts, and led by globally essential companies. If you're still treating this market like a macro blip, you're not just missing the opportunity, you're misreading the entire cycle. And in markets, that misread costs real money. Let's move on to the next piece. How AI is driving a supply-side revolution, and why Japan is built to lead it. Step 2. AI hype? No, this is a supply-side revolution. Conclusion, Japan's AI story isn't about hype, it's about hardware. In the US, AI mostly means ChatGPT, language models, or image generation tools. It's a software-centric story, all about algorithms and data. But in Japan, AI is taking a completely different shape. Here, the real transformation is happening inside factories, inspection systems, and power-efficient hardware. It's not about flashy demos, it's about the tools that make AI deployment at scale even possible. That's the part of the AI cycle Japan dominates. And if you're ignoring this, you're missing the real foundation of the AI economy. Reason: Japan is critical to scaling AI at the infrastructure level. Think of the AI supply chain as a pyramid. At the top, you have consumer-facing applications, chatbots, voice assistants, image generators. In the middle, GPUs, chips, server farms. That's where NVIDIA and TSMC live. But at the base, you find the infrastructure layer, inspection tools, lithography validation, power efficiency optimization, thermal control, and high-yield manufacturing. This is Japan's playground. Why? Because Japan has spent decades perfecting precision manufacturing. Its companies lead in metrology, defect detection, and power optimization, areas that become bottlenecks as AI hardware demand explodes. If chips are the brain of AI, then Japan provides the nervous system that keeps it stable and scalable. Example, Lasertec's HSA300 is solving a bottleneck nobody talks about. Let's zoom in on Lasertec's flagship product, the HSA300. This system performs actinic inspection for EUV masks, a key component for high-NA EUV lithography. In plain English, it checks whether the masks used to print ultra-tiny chips are free of microscopic defects. That may sound boring, until you realize this is the single biggest bottleneck in pushing AI-capable chips into mass production. Without clean masks, there's no high-yield manufacturing. Without high yield, costs spike. Without cost control, AI adoption slows down. Lasertec's tech ensures that the next generation of chips can be built efficiently and reliably. That's not hype, that's infrastructure. And the market is starting to notice. That's why Lasertec just hit a limit up, not because of a trend, but because demand is structurally exploding. Summary: Japan isn't chasing the AI boom, it's enabling it. While the market obsesses over AI applications, the real alpha is forming quietly at the base of the tech stack. And Japan is perfectly positioned, not because of luck, but because it has spent years building precision, reliability, and manufacturing excellence. Lasertec, Vantage, Tokyo Electron, these aren't just team stocks, they're foundational to the AI cycle's next phase, scaling production and driving down costs. So no, Japan's AI story isn't about hype, it's about solving real problems with real machines and making AI work in the physical world. Let's move to step 3, where we'll unpack how high-priced Japanese tech names are not risky outliers, but critical levers in a price-weighted index. Step 3. High-priced Nikkei risk think index leverage. Conclusion: high-priced Japanese tech stocks are not fragile. They're structurally important. Many global investors flinch when they see Lasertec trading near 28,000 yen or Advantest above 22,000 yen. They assume high price equals high risk. They assume these stocks are overextended or prone to correction. But that's a misunderstanding, because price matters more than market cap in Japan's most watched index, the Nikkei 225. In a price-weighted index, stock price drives index contribution. So when high-price stocks move, they move the market. Lasertec and Advantest aren't just volatile outliers, they're pillars of index performance, and that makes them critical to how capital flows into Japan. Reason Japan's price-weighted index changes how investors should think. In the US, we're used to market cap-weighted indices like the S&P 500 or Nasdaq 100, but the Nikkei 225 works differently. It assigns equal weight to each company, then multiplies by price. That means a stock trading at 25,000 yen affects the index far more than one trading at 2,000, even if the latter has a larger market cap. So when global capital allocators rotate into Japan via ETFs or index-linked instruments, they're forced to own more of these high-priced names regardless of personal conviction. That creates a self-reinforcing mechanism. As earnings improve, price rises, RealTo index impact grows, more fund flow follows. It's not just fundamentals, it's mechanical leverage. Example: Lasertec is Japan's version of NVIDIA in terms of index gravity. Let's compare Lasertec to something more familiar. NVIDIA. In the Nasdaq 100, NVIDIA dominates due to both market cap and narrative. Its movements send ripples across ETFs, mutual funds, and retail portfolios. Now apply that logic to Japan. Lasertec may not be a trillion-dollar giant, But at 28,000 yen per share, its impact on the Nikkei is massive. When it goes limit up, as it did recently, it's not just Lasertec shareholders who benefit. It pushes the entire index higher, triggering algorithmic buying, ETF inflows, and momentum chasers. The same goes for Vantage, Tokyo Electron, and other high-price leaders. They are the accelerators in Japan's equity engine. Ignoring them isn't just a missed opportunity, it's a misread of how the system works. Summary: in Japan, high price means high influence, not high fragility. If you're applying US-style valuation fields to Japanese high flyers, you're misjudging both the market structure and investor psychology. Lasertec isn't expensive in the way most think. It's a high-impact asset in a price-weighted environment, one that global flows gravitate toward by design. When these names move, they don't just reflect strength, they create it. They lead the index, attract foreign capital, and anchor Japan's equity narrative. So next time you see a 25,000 plus yen stock in Japan, don't flinch, understand the mechanics, respect the leverage, and position accordingly. Coming up in Step 4, we'll look at how Japan's semiconductor strength extends into automation, energy efficiency, and industrial tech, and why the next wave of growth is already taking shape. Step 4, beyond semiconductors, watch the domino effect. Conclusion: Japan's advantage doesn't end with semiconductors, it expands across the industrial value chain. Too many investors stop the story at chips. They see Lasertec, Vantage, Tokyo Electron, and think, okay, Japan's having a semiconductor moment. But that's only part of the picture, because what's actually happening is the beginning of an industrial domino effect, where the gains in semiconductors flow directly into automation, energy efficiency, robotics, and smart manufacturing. Japan isn't a one-trick pony. It's building a layered economic engine with semiconductors at the core, but far from the end. Reason: AI's hardware demands are spilling over into adjacent industrial sectors. As the global AI boom accelerates, so do the demands on infrastructure, not just to produce chips, but to build, maintain, and optimize the environments where those chips operate. This creates a ripple effect. Automation: AI-capable factories require precision, speed, and low error tolerance. That's Japan's domain. Robot arms, motion controllers, servo motors, energy efficiency. AI workloads are power-hungry. Japan's leadership in efficient components like inverters, sensors, power semiconductors becomes critical. Industrial IoT and monitoring. Once chips are deployed, they need real-world visibility. That means sensor networks, real-time analytics, and quality assurance tech. Again, areas where Japan has quietly built dominance. This is not theoretical. It's happening right now, and it's triggering earnings momentum across entire sectors most investors aren't even watching. Examples from Lasertec to Fanuc to Kien's Japan's chain is activating. Let's follow the domino trail. Lasertec and Vantage are the tip of the spear riding the capex wave for chip manufacturing. But who builds the robots that assemble the components? Fanuc, who provides the ultra-sensitive sensors for measurement and control. Kien's, who leads in miniaturized automation, power devices, and smart production lines. Think Omron, Yasukawa Electric, Murata Manufacturing. These companies aren't riding hype. They're logging real demand increases as global supply chains race to upgrade their AI readiness. It's like watching the 2020 cloud boom ripple through chips, memory, storage, and then SaaS. Same mechanics, different vertical. Japan's industrial tech base is now the second layer of the AI trade. Summary: Japan's strength lies in the chain, not just the chip. If you're only looking at semiconductor tickers, you're missing the broader opportunity. Japan's competitive edge isn't isolated to one sector. It's interconnected, from mask inspection to factory robotics, from power efficiency to real-time sensor ecosystems. This is how Japan quietly builds momentum, not with headlines, but with layered, linked productivity across entire industries. And for long-term investors, that means multiple entry points, diverse cash flow profiles, and defensible advantages in a world desperate for efficiency and resilience. Semiconductors are just the spark. The fire is spreading, and Japan is the fuel. If you made it this far, let me be clear. You're not here just for surface-level headlines or flashy stock tips. You're here because you sense something deeper. That Japan isn't just rallying, it's repositioning. This video wasn't about telling you what to buy tomorrow. It was about showing you how the layers of Japan's industrial ecosystem are converging, quietly and powerfully, under the global AI wave. And you're now one of the few who actually understands why Lasertec hitting limit up isn't noise, but signal. This is what separates short-term chasers from long-term strategists. Understanding structure, recognizing timing, and leaning into narratives before they're mainstream. So here's what I want you to do next. First, rewatch this video, take notes, let the insights compound. Most people click once and move on. But those who rewatch, absorb, and reflect, those are the ones who build actual conviction, and conviction beats luck every time. Second, subscribe to Japan Market Samurai. Every video we put out is built on primary sources, earnings calls, and real institutional level frameworks. We don't do hype, we don't chase clicks. We break down the moves before the headlines catch up. Third, if this video helped you see Japan's market in a different light, hit the like button. It tells the algorithm this content matters. But more importantly, it tells me this type of deep dive analysis is what you want more of. And finally, drop a comment below. What sectors in Japan do you want to understand next? What themes are you hearing that still feel confusing or underexplored? This isn't just my channel, it's a platform for building sharper, globally aware investors. Let's build it together. Let's do a quick recap. Step 1. Japan's rally is not a repeat of 1989. It's grounded in EPS growth, ROE improvements, and shareholder-friendly reform. Step 2. The AI hype. In Japan, it's a supply-side revolution, with companies like Lasertec solving real-world infrastructure bottlenecks. Step 3. High-priced stocks like Vantage aren't risky. They're index levers, powering the Nikkei by design. Step 4. Japan's edge extends beyond semiconductors into automation, energy efficiency, and industrial IoT. Each of these steps forms a layered thesis, one that's easy to overlook, but extremely hard to compete with once it compounds. This isn't just about making better trades, it's about seeing the macro through the micro, the narrative through the numbers, and that's what gives you a lasting edge. Thanks for watching. This isn't a market where you can afford to react late. Information travels fast, but conviction travels slow. You've got to build it before the crowd catches on. And that's exactly what we do here at Japan Market Samurai. So if you're ready to keep sharpening your edge, stay tuned. Next video, we'll dig even deeper. Until then, stay curious, stay strategic, and stay early. See you in the next one.